Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson, we continued our module on the logistics of futures trading with a look at volume and open interest. In today's lesson, we're going to continue our free futures trading course with a look at a report which shows the positioning of different participants in each futures market, known as the Commitment of Traders report. So let's get started.
The Commitment of Traders Report, or COT report for short, is a report issued each Friday by the CFTC which shows the positions of commercial hedgers and large speculators in the different futures markets, including the S&P and E-mini S&P contracts. While the report shows data with a 3-day lag, the fact that the positioning information of the two largest participants in each market are reported at all is pretty impressive and can provide traders with some interesting insight into potential future direction of prices. Before we get into the details of how traders use this report, it is important to understand that participants in the futures market are broken down into 3 categories. Number 1 is commercial hedgers. Commercial hedgers are producers and users of commodities who participate in the futures market to lock in future prices or to protect against large adverse moves in the market for the underlying commodity or financial future that they use. An example of a commercial hedger would be Nestle, who uses the futures markets to hedge the cost of cocoa, which they use to make their chocolate. Number 2 is large speculators. Traders who have open positions above a certain size are required to report their holdings to the CFTC, who in return reports those positions on a weekly basis in the Commitment of Traders report. The position size level which requires reporting varies by market, but to give you an idea, the reporting size for the S&P futures is currently 1,000 contracts. When considering that the full-size S&P contract is 5 times the size of the E-mini S&P, you can see the reason why these traders are often referred to as large speculators. Number 3 is small speculators. Small speculators basically include everyone that is not included in the above 2 categories, and although this category is generally referred to as small speculators, it is important to understand that hedgers who do not meet the reporting requirement outlined above are also included here. Now that we understand this, let's take a look at how knowing the positioning of each of the traders in the above 3 categories can give us potential insight into the future direction of market prices. First, let's look at commercial hedgers. As commercial hedgers actually produce or use the underlying commodity, they often have a better insight into where the price of the underlying commodity should be, as they are on the ground, so to speak. With this in mind, traders will often look at the open interest data provided for the commercials and look for movement which is out of the ordinary as a tip on where the future price action may be headed. As an example, oftentimes commercial hedgers are the most bullish at market bottoms and the most bearish at market tops. With this in mind, by looking at a historical chart of the COT data for commercials and looking at their positioning levels at other major market bottoms and market tops, we can gauge the potential positioning levels where it might be prudent to look for a trend reversal when looking at current market data. Generally, large speculators are trend followers, meaning that the more the market moves in one direction, the more large speculators are going to trade in that direction. With this in mind, oftentimes what traders will look for when watching the large speculator data is the same type of extreme we just covered in the commercial speculator data. The difference here is that this time when the net long or net short positioning of large speculators reaches an extreme, this is an indication that they are all in the market on the same side of the trade. Logically, it makes sense here that if all the largest players are in the market on one side of a trade, there may be no one left to continue putting on trades in the direction of the trend. With this in mind, extreme positioning in one direction or the other by large speculators may indicate an impending trend reversal as well. While the data for small speculators is not reported, because the data for the other two categories are, you can easily calculate the net positioning of small speculators, as it is basically what's left over after looking at the first two categories. As we discuss above, however, the data for small speculators also includes small hedgers, who often have a much better read on the market than the typical small speculator. With this in mind, generally traders will not pay too much attention to this category of data and focus instead on the commercials and large speculators. As with any analytical tool, there are many different ways in which this data can be used depending on your trading style, so the above is simply meant as a general overview. To help you learn more about the Commitment of Traders report, I've included some links below this video, as well as where you can find free charts which show the data for each category of traders that we've just covered. That's our lesson for today. In our next lesson, we'll wrap up our module on the logistics of futures trading with a look at trading limits, so I hope to see you then. As always, if there's any questions or comments, please feel free to leave them in the comments section below, and good luck with your trading.